Hello and welcome everyone to Navigating the New Financial Responsibility Rules, our webinar hosted by Dean Dorton. Presenting today, we have Lance Mann, our Assurance Director.
Good morning, everybody. I hope you're well today. I'm grateful that you all have joined us today to learn a little bit more about the financial responsibility rules. We're hosting it today because we had several of our that's not our clients, but we talked to several other institutions who still were a little behind on implementing it, and so we thought it was timely to go ahead and put out this presentation for those who may not have issued their uniform guidance financials yet, which will require inclusion of these new schedules and making these changes. For anybody who is a public institution, these rules do not apply to you. So if you signed up in error and you thought this would apply to you, public institutions do not have to apply these new rules. However, you're welcome to stay on and get the CPE that we'll be providing for this webinar, or if you'd like to learn more about what your private constituents are dealing with these days. So without further ado, I will go through some of the early slides quite quickly. Because it's stuff that I believe you all should already know. I want to dig in on some of the major changes that will affect your financial statements, which are later in the presentation. Our objectives today are to understand the financial responsibility rules, understand the major changes and some of the changes that may impact your financials, how to prepare the financial responsibility supplemental schedule, and some non-GAAP items that will be required in your financials. Maybe give you a little bit of an auditor perspective and expectations on the schedule and the non-GAAP items. Talk about your uniform guidance, audit package recommendations, and any issues identified to date. So Title IV financial responsibility standards are in place because institutions must demonstrate financial health to participate in Title IV. It's intended to guard against precipitous closure and to ensure that resources are available to provide education. In layman's terms, these rules are in place to make sure that students are going to get what they're paying for, and they're going to be able to leave with another degree. They're going to be able to leave with a degree if they so choose to spend 4 years with you. And it came about because some institutions weren't managing their resources responsibly, and some were closing. 3 key ratios are calculated, weighted, and combined into a composite score. As I mentioned before, these are for not-for-profit institutions, proprietary institutions, public institutions are exempt. The 3 key ratios are the primary reserve ratio, the equity ratio, and the net income ratio. Each of these are weighted slightly differently and combined into one composite score that you're evaluated against. And many of you on the call are very familiar with this weighting and the composite score and how it could impact oversight from the Department of Education. The primary reserve ratio measures if the institution has the financial resources available to support its mission, and it evaluates financial reserves are sufficient to meet current and future operating commitments. The equity looks at your total capitalization structure and understands how your resources are financed. And then the net income looks at your profitability. You know, what's the future hold for you in terms of your net income? So why are we making changes? Well, part of the reason we're making changes is because FASB changed some of the rules for nonprofits and changed some of the terminology and how things are categorized. And so that in and of itself required an update. There were concerns over how debt was being maybe manipulated in ways to help people have improved composite score numbers at the end of the year. And then there were some corrections and there were some things put in place to reduce the Department of Education's judgment and how they take your financial statements and calculate your composite score. These numbers should be very familiar to you all, but these are the composite score ranges. You know, if you fail between the -1 and 0.9, you've got a provide ED with a letter of credit of at least 10% of prior year Title IV funds. If you're in the 1 to 1.4, you've got enhanced monitoring, special disbursement requirements, things like that. And if you're over a 1.5 on the composite score, you pass, you're good. You shouldn't have any enhanced monitoring or letter of credit requirements. So here's the changes to the primary reserve ratio, or this is the new calculation for the primary reserve ratio. And so you'll notice a lot of it is changing with the rules around without donor restrictions and with donor restrictions. And I won't read this to you because you can download the slides. But you do take all of your net assets, you subtract out what's permanently restricted, meaning it's your endowment money, it's monies that you can't use, and then subtract out some non-spendable monies, your PP&E and your intangibles, and you get to add back your debt so long as it doesn't exceed PP&E, and unemployment benefits and things like that. We're going to get into debt and property and equipment later because there are some new rules around how much debt you can add back, which could impact some people's calculations. I've already seen it impact some of my clients' calculations. I had a bunch of asterisks because you can't write a law and not have a bunch of footnotes in terms of what these things mean. I'm going to dig into each of these later in the presentation around how they should be accounted for in the calculations. So the denominator for the primary reserve is your total expenses without donor restrictions and total losses without donor, plus total losses without donor restriction, minus losses without donor restrictions on investments, post-employment, and defined benefit plans. And the formula in the regulation says annuities. The Department of Ed has come back and said that this is a mistake. They've not issued anything yet. And the Easy Audit does not exclude this loss. So there may be new guidance about that in the future, but just wanted to point that out to you. I know I don't have any great answers for you in that respect, but did want to point it out to you. So the net income ratio, obviously less well weighted. The primary reserve ratio is significantly weighted because it looks at what resources do you have to make sure you're going to keep the doors open? Can you pay your bills for the foreseeable future? The net income ratio is less weighted because your net income can fluctuate significantly in any one year depending on things that may happen in a given year. You got a bunch of higher education relief funds, so that's going to, and while you had losses in the year, many institutions had a gain because of their higher education relief funds, or you got a paycheck protection loan and things like that. That could change your net income in a given year. Or COVID-19 happens, so that's why it's less weighted. So the numerator is change in net assets without donor restrictions divided by total revenue without donor restrictions plus total gains without donor restrictions. And those are pulled right off your statement of activities. So there is one, so the denominator is total revenue and gains without donor restrictions. There are certain institutions that separately report investment spending as operating revenue. So your spending rule from your endowment, and then the remaining net investment return or loss is shown as a non-operating item. When you do the calculation, you actually need to aggregate these two amounts together to determine if there was a net investment gain or a net investment loss. So just remember that part. Funds functioning as an endowment, and so this is just an example of the calculation. If you have a net investment gain, you add that revenue to the net income ratio denominator. If you have a net investment loss, you don't have to add that in. It has no impact to your net income ratio or your primary reserve ratio. Okay, your equity ratio. So your equity ratio is your net assets without donor restrictions plus your net assets with donor restrictions minus intangible assets and unsecured related party receivables divided by total assets minus these same types of assets. So really looking at, are you financing your institution with debt or with equity? Okay, so that's the easy stuff. The next few slides, we're going to go through what were the significant changes. So one, you're going to have to add a supplemental schedule to your audited financial statements. In essence, you're going to go ahead and do the calculation on behalf of the Department of Ed and put that calculation in your financial statements. Debt obtained for long-term purposes is going to be limited to that debt that is used to finance PP&E. Leases, for those who have implemented the new lease standard, there's some special rules around how leases have got to be handled. And there's multiple dates you have to remember for leases. Property, plant, and equipment, you're going to have to track pre-implementation debt and post-implementation debt. So that way you can also track the debt side of things as well. Pre-implementation PP&E and post-implementation PP&E, so they can mirror along with the debt disclosures. There's some changes in expenses and losses and revenues and gains in a new Easy Audit template. And we're going to go through all of these. So, I mentioned before, you've got to have a supplemental schedule must be submitted as part of the audited statements. It has to be part of the audit opinion. The auditors have to give some opinion on it. It must include all financial elements required to compute the composite score. At the very end of this presentation, we have some example supplemental schedules for you that you can just take and use. All of that sounded easy for me when I first started learning about it, and then I heard that each item in the supplemental schedule must have a reference to the statement of financial position, the statement of activities, the schedule of natural functional expenses, or a note to the financial statements. And so when you start thinking about pre-implementation and post-implementation debt, leases, PP&E, well, those aren't in typical GAAP financial statements. And so we'll talk about some options there. And so the supplemental schedule will be used as the source for input into the Easy Audit system. You can design your supplemental schedule to crosswalk directly to the Easy Audit schedule. You can kind of do the supplemental schedule however you want. There's no requirement on how you do it, but you have to do it. And we'll see some examples here in a little while. So the pre and post implementation rules. The first one I'm going to go through because it's the most complicated one, I think. At least currently the most complicated one is the debt obtained for long-term purposes. So your pre-implementation debt obtained for long-term purposes should be the ending balance of debt reflected in your audited financial statements for 2019. So if you're a June 30 year end or a 5/31 year end, your June 30, 19 financial statements or your 5/31/19 financial statements, that debt balance up to the amount of PP&E, if you have debt in excess of PP&E, is your pre-implementation debt obtained for long-term purposes. If you paid off any of those or made payments on any of those individual debt facilities in fiscal year 2020, I know you're adopting it in 2020, but the pre-implementation amount is the amount before you implemented it. So you're implementing it in 20. Any activity goes to reduce your pre-implementation debt obtained for long-term purposes in 2020. So, for example, if you had a long-term line of credit and you paid it off in September that year, and then you drew on it again throughout the year, your pre-implementation debt for that line of credit is zero because you paid it off throughout the year, and all new debt that you took out later in the year is now post-implementation debt. And that'll matter because depending on whether or not you use the money for PP&E or construction in progress or not, will impact whether or not you get to add it back. Post-implementation debt is any debt that you acquire in the fiscal year that you implement it, which is your fiscal 2020, and any debt in future years. And post-implementation debt must be reduced by any payments or other reductions as well. To be considered debt obtained for long-term purposes, to be added back in the calculation, it must be for the acquisition or development of PP&E, capital leases, or right-of-use assets. The value of post-implementation debt that may be included cannot be greater than the value of post-implementation PP&E, for which debt was used to purchase it, which is why we're also tracking pre- and post-implementation PP&E. So other long-term debt considerations. What about refinanced or renegotiated debt? We've got an example about that right here. Is pre-implementation debt related to the purchase of PP&E still qualified? There's a lot of people who refinanced their debt in 2020. Interest rates were low. It was a good year to do it. So long as you refinance the debt at the same amount that you had outstanding, it can still be considered pre-implementation debt. If you said, hey, we're going to take out an extra $100,000 on that line so we can add something new, upgrade our fiber optics or whatever else, if you increase it, it is no longer pre-implementation debt. It is now post-implementation debt. And there's other rules to still be considered pre-implementation debt. It can't be credit facility, it can't be an arm's length transaction, or it has to be an arm's length transaction, and it can't be a related party. And this is kind of the same thing. What if it does increase your debt, and it's not all those? If it does increase it, the refinance debt is no longer considered qualified debt. PPP loans, I've got down here, you have two options for PPP loans for those who haven't done their calculation yet. One option, and it also depends on whether or not you've gotten forgiveness and all those. But there was an FAQ that came out during the year that said if you got a PPP loan and you've not gotten forgiveness yet and you're still showing it as debt on your balance sheet, you can go ahead and add that to unrestricted net assets when you're doing your calculation. So that's an option. For those of you who went ahead and recognized it into income, there should be no need to use that FAQ, but you do have that option on the PPP loans this year. Credit facilities is an interesting, you have to look at it in an interesting way. We talked about this briefly earlier. So here's an example where we had $40 million credit facility for pre-implementation debt. During the year, you made a $20 million payment, and you borrowed $30 million, $15 million of which was for PP&E. That $20 million payment first goes to pre-implementation debt, and then you get to split the $15 million amount of new borrowings between PP&E related and working capital related. The debt obtained for long-term purposes in this example would be $35 million and could be used as an adjustment to expendable net assets. The $15 million would not, the other $15 million would not get added back. So that would be, let's say that's fiscal 2020, what happened for you all. This next example is in fiscal 2021. In fiscal 2021, we made $36 million of payments on our credit debt facility. And this is obviously a simplified example, but the first thing you have to do is apply the first $20 million payment to pre-implementation debt. The standards are pretty clear. Any payments made go first for implementation. Next, you pay off any debt related to PP&E automatically, and any remaining payments go to reduce your working capital amounts. And so in this example, you would add none of the debt back into your calculations. You would just have the $14 million of non-PP&E debt. Okay, Julie, I'm going to pause right there. Have any questions come through before I get into capital leases?
None yet so far.
Okay, thank you.
Thank you.
So if we were in person, I would everybody raise their hand and say, who adopted the new capital lease standard last year? And my gut would be, I might get one person raising their hand, but I would bet nobody adopted it last year. So for those, hopefully you're familiar with it, but there's a new rule out there. It's FASB ASC 842. And it's going to require you to bring all leases onto your books. Operating leases, capital leases are already on your books, but all are operating leases, and all contracts that have some form of a fixed asset assigned to it is going to have to come on your books as right-of-use assets, and you're going to have a liability for right-of-use liability. And so that could significantly impact your calculations. So when they were doing the update to the responsibility rules, they went ahead and added rules around these new leases. So your capital lease assets as of your 2019 year end will be shown in pre-implementation PP&E, and the associated liabilities for those capital leases should be shown in pre-implementation debt obtained for long-term purposes. For new capital leases entered into in FY 2020, the assets are in post-implementation PP&E, and the liabilities are in post-implementation debt obtained for long-term purposes. During the year of 2020, if you made payments on your capital lease liabilities, that reduced your pre-implementation debt obtained for long-term purposes. Now we've got the conundrum of right-of-use assets and liabilities. These will be included. Right now, the rules read that these should be included in your pre- and post-implementation PP&E and debt. I've got a slide later. I think you could show your right-of-use assets and liabilities separate from PP&E and debt and just treat them the same when you do your schedule. That'll be up to you and your audit firm. We've gotten the statistic that about 10% of institutions implemented the new leasing standard. I think that's high based on our client base. But as I mentioned before, the right-of-use assets would be in the pre and post PP&E and debt obtained for long-term purposes. But I think you can separate them out from PP&E and debt if you want to when you do your schedule. Maybe easier to track that way. So there's some special rules around leases, and that's why it's a little more complicated. So when you do adopt it, and right now for you all, it's effective for you June 30, 2023, or May 31, 2023, you have the option to take advantage of a transition election. It is not reversible. If you take advantage of the transition election, you get what they call grandfathered operating leases. So if you decide to take this election, any lease that you had entered into on or before December 15th of 2018, you would not put on your balance sheet as a right of, for the purposes of this calculation, you would not have to apply the new lease standards when doing your financial responsibility supplemental schedule. You would likely have to add a new disclosure to your financial statements, separating your leases out into the various buckets of grandfathered and non-grandfathered leases. But for any lease entered into on December 15th or before, you can grandfather in, and all that you'll have is lease expense and depreciation. So it's up to you if you want to do that. We have an example in a little while. It probably is going to complicate your life more than you want it to take advantage of this transaction election based on the benefit you get in your calculation. But we wanted to make sure you were aware. So here's an example calculation. So you had $30 million of operating leases. Most $29,850,000 was prior to December 15th, 2018. 150 was after. Then you roll it forward with current year activity, and so you notice your payments of $3 million during the year brings your pre-implementation leases down to $26,850. You notice we're only using the grandfathered leases here, and the lease asset post-implementation was 150. We added more, 600. For those who chose to grandfather, you'll notice chose not to grandfather, their total assets were $15 million, or $1,561,850,000. Down there at the bottom, they had a weighted score of 0.85. An institution that chose to grandfather had a weighted score of 0.86. So it's not really making that big of a difference in this example. The big question is, do you want to have to track leases prior to 12/15/18, leases between 12/15/18 and whatever your 2019 year end is, and leases after your 2019 year end until the ends of all those leases to do it? Most of the clients I've worked with on this are not taking advantage of this grandfathering rule, but we haven't implemented their new lease standard yet, so we'll see how they feel in a couple of years. But my guess is when you get to adopting this, most of those leases will have already run their course, and you won't be using them anymore and won't have much benefit. PP&E, just like debt, you need to know your pre and post implementation PP&E. PP&E includes your construction in progress. This is not a GAAP requirement for tracking these things, so you likely need to consider putting it in your notes to try to not complicate matters. Just like debt, your pre-implementation PP&E is the amount shown on your 2019 audit report. Any depreciation that you may have had for those assets, you would reduce PP&E. Any disposal, so forth and so on, you'd use to reduce it. And then any new additions in your fiscal 2020 would all be post-implementation PP&E. We just went through the information on this slide, but any PP&E you added since the first day of FY 2020 is when. And you're going to have to track both PP&E acquired with debt and PP&E not acquired with debt. And you're going to have to track these separately going forward, including depreciation on the amounts. So that will be fun. Here's an example disclosure for PP&E. We're going to have some more of these here in a little while, but you'll notice here you've got a pretty significant pre-implementation PP&E, less depreciation and disposals equals the adjusted pre-implementation PP&E on these books, and you've got the post-implementation with debt and post-implementation without debt and construction in progress. So those are the changes on debt, PP&E, and leases. So now we're going to move over to the the income statement, statement of activities. So what ratios are being impacted by these changes to gains and losses? And so your primary reserve ratio equals your expendable net assets divided by expendable expenses and losses. And so you'll notice the losses without donor restrictions on investments, post-employment defined benefit pension plans, and your net income ratio is going to be effective. And make sure to correctly capture all of your gains. You're aggregating your endowment spending with your endowment net return, your investment net return, to show whether do you have a positive gain for the year or a loss for the year. So I found this to be a useful table. I think Nakubo put it out, but in essence, if you have for investment return, if you have a positive investment return for the year, so a credit balance, you do include it in revenue. If you have a negative balance or a debit balance, it does not get shown, and so forth and so on. So for non-service component of post-employment benefits or pensions, which I doubt many people have anymore, those do. If it's a negative, it goes in expense. If it's a positive, it goes into revenue. Pension, other pension-related changes only include if it's a positive number. Change in value of annuity agreements only include if it's positive. Interest rate swap agreements you include in both places. And this is gains and losses in the various ratios. Some similar information here to help you as you work through it. And this is, these are those non-operating items that we were talking about earlier. But I found these to be useful. So here's an example. You'll notice here how this information shows up. So you've got non-operating and net investment losses and where the total of these amounts are showing up. So the losses, negative $653,000, showing up over in the primary reserve ratio on the right, and your gains are down in your net income ratio in the bottom. But you'll notice your net investment gain is obviously not showing up in your non-operating and net investment losses for your primary reserve. It's only showing up in the one place. Another example here, you'll notice the net investment gain or loss is in non-operating and net investment losses, working your way down to the $4.103 million, and you've got that in the primary reserve ratio and not in the net income ratio, and how those things differentiate there. So audit considerations. We've got some presentation considerations, the financial statements and the reports, and the dating of the reports. The dating is important, and I'll go through that in a minute, depending on how you decide to show these disclosures. And so you've got several options for how do you adopt these in your financial statements. The first one is to adopt it in your general purpose or short form financial statements. These are just your basic financial statements. They don't include your uniform guidance. You would still have to add the supplemental schedule, and you'd have to add the non-GAAP details. Some things to consider is, will anybody understand? Is this going to clutter up the statements? Can we get it all done in time to get our financials to the board in time? Do we want this to clutter up the financials we send to our lenders or, other constituents that may get them? Option number 2 is to include them in your uniform guidance financial statements, your single audit financial statements. This is the option I think most of my clients are going to take advantage of because it's already quite cluttered with the single audit information. And so you would do the same thing. You'd add the supplemental schedule and the financial responsibility notes to the financial statements only for this version of the financial statements. Single audit statements have previously been submitted to to the Department of Ed for easy audit filing, and so it'd be consistent with how you have been doing it in the past. But they are available to the public, so you have to consider that. I've heard an option. I've not had anybody take advantage of it yet because of there'd be increased cost and increased complexity of just doing a third set of financial statements just for the ED that doesn't include your uniform guidance, but includes your information for the easy audit filing. And so you'd have 3 different types of financials that you could do it for. And so these are just things for you all to consider and talk to your auditor about, and what it would cost and how much time it would take and what makes the most sense for you. I've seen option number 2 being taken advantage of the most. So we've talked about all of this new information that has to be included in the note. And so the supplemental schedule that you do, you will have the name of the line on the supplemental schedule. Okay, so net assets without donor restrictions. The next column over, you're going to have to type in what page of the financials can I find that on? Is it on page 2? Is it on the statement of financial position or statement of activities? You're going to have to reference it. So when you think about pre and post implementation debt, those numbers are not in typical financial statements. And so you wouldn't be able to reference note 12 to the financials on your schedule. And so you're going to have to do a couple things. One option was the option I originally went down, was adding it to your PP&E note or your debt note or your lease note, and just adding a reconciliation at the bottom that included all the components. As we worked through it and talked to Nakubo and others in the area, we determined that it made more sense to simply create a financial responsibility footnote, which is the option I think most of our clients are going to do. And so I just add a note at the end of my financial statements for the clients that show, here are the reconciliations that are required for the financial responsibility schedules. And here's some examples of those disclosures. And so in your net asset disclosure, if you don't already have net assets restricted in perpetuity called out separately, you could add it there. There's some other net assets with donor restrictions that have to be added back. If you don't have those specifically called out in your already net asset disclosure, you'd call those out here. The ones I think most people are interested in are your debt and PP&E notes. So here's an example PP&E disclosure. And for everybody's reference, for the ones I've done so far, I've just included all of these reconciliations in one disclosure with the subheadings of what I'm reconciling here. So you'll notice we've got pre-implementation property and equipment, the ending balance from their June 30, 2019 financial statement, less depreciation and disposals just on those assets, equals your balance of pre-implementation property and equipment. We have debt finance post-implementation property and equipment. I've added $450,000. We've got construction in progress of $3 million, and we've got post-implementation debt acquired without debt of $2,150,000 for a total of $55,600,012. That $55,600,000 should refer back to your statement of financial position and match that perfectly, or to your PP&E note, depending on how much detail you have. But now this note has everything needed for your supplemental schedule. You will have to disclose the terms of current year debt and lines of credit for CIP additions. And so here's an example that you could add in to your financial statement disclosures. And the right of use assets and liabilities. As we mentioned earlier, for the leases, likely this doesn't affect most of you yet, but be prepared to have these reconciliations in place when you start to adopt it in a couple of years. I promise we're getting close to the end for those who are overhearing me say financial responsibility. So what are your reporting deadlines to the DOE? Normally it would be 9 months after your end of your fiscal year. Due to COVID, you've got an extra 3 months. so a full year from your previous year-end date, so either 5/31 or June 30, depending on you. You need to start thinking about what version of the financial statements are you going to attach when you do that work. So I'd go ahead and start getting with your auditor now about it, or give them a couple weeks since they're in the middle of their busy season. But soon I'll be getting with your audit firm. Need to start determining what your supplemental schedule will look like. Are you relying on your auditor to prepare it for you? Are you comfortable with them doing it for you? Do you want to have some more influence into that process? Another thing to go ahead and start talking to your audit firm about now. There's no one prescribed format to your supplemental schedule. There's no requirement. The general recommendation is to try to mirror the inputs into Easy Audit, as that could result in fewer questions from the DOE. Go ahead and start thinking about your footnote in your financial statement so you can reference it. And I'm going to pause there, Julia, because the remaining slides I have are examples of the supplemental schedule. So does anybody have any questions pre-supplemental schedule?
We have not gotten any questions yet, but maybe if we wait a second, people can jump on in.
Get your questions in. We've got about 5 minutes left. I'm happy to stay on as long as we have questions, but about 5 more minutes of content, and then we'll be done. So we've got 2 examples of the supplemental schedule to go through. The first one is 5 pages long. It starts with the actual calculations of the composite score, and then it goes into the details of that calculation. I know this is very blurry, but you'll notice on the left-hand side, location in the financial statements and financial element, GAAP financial statement, line item or disclosure, and amount used in the ratio. And so these would be two separate pages here. And you'll notice one saying the bold headings there is which calculation are we doing? The primary reserve ratio, expendable net assets, right up in here. And then you get into the primary reserve ratio, expenses and losses. Over on the right-hand side, the equity ratio, and down at the bottom, the net income ratio. So that's one option. This next option is the one that I've used more often. It's 2 pages, and it literally just shows the information necessary for them to calculate it. So it's not doing the calculation on the supplemental schedule. But you'll notice it does in the middle there, it specifically references where in your footnotes or in your financials you find them. I know that was very quick. Many of you on the call have my number. Feel free to call me. But if you'd like to email or call me now or in the future, feel free to reach out directly anytime. I'd be glad to help.